This makes no sense. Silver sat frozen at $72.99, while the most consequential jobs report in months detonated the entire Federal Reserve rate cut narrative. The non-farm payrolls number crushed every economist's forecast. Bond yields surged, the dollar spiked, and silver has been locked in suspended animation for 3 full days with zero price discovery between Thursday's close and Sunday's 6 p.m. Eastern opening bell. If you're confused, you should be. If you think Sunday's open will be orderly price discovery, you've been deceived. If you believe the gap between where silver closed and where it should open represents normal market behavior, I'm about to shatter that illusion. A jobs report that removed the Fed's urgency to cut rates, a 3-day market closure that prevented any reaction, and a setup where every participant from institutional desks to retail traders will be hitting bid and ask at the exact same moment with identical information and zero ability to gauge sentiment before committing capital. This was not accidental scheduling. This was designed chaos. Welcome to the market Cipher. I'm here to decode exactly what Friday's NFP data means for silver, why the 3-day information blackout creates one of the rarest setups in commodity markets, and what the data says is coming the instant that Sunday bell rings. Let me be crystal clear from the start. The non-farm payrolls report didn't just beat expectations. It obliterated the narrative that the American economy is slowing and that the Fed needs to rescue it with rate cuts. 178,000 jobs added versus 60,000 expected. Unemployment dropped to 4.3% from 4.4%, and the bond market's reaction tells you everything about what comes next. This wasn't a modest upside surprise. This was a decisive rejection of the dovish pivot that silver bulls had been counting on to drive the next leg higher. And the fact that markets closed for Good Friday before anyone could react means Sunday's opening gap will carry the full weight of 3 days of suspended judgment released in a single instant. Let me walk you through exactly what happened. Friday morning at 8:30 a.m. Eastern, the Bureau of Labor Statistics released March employment data. The headline number hit 178,000 new jobs against consensus expectations of just 60,000. This represented the strongest monthly gain since December 2024. The unemployment rate didn't just hold steady. It declined to 4.3% from February's 4.4%, moving in the opposite direction of what labor market softening would suggest. Healthcare led with 76,000 new positions. Construction added 26,000 jobs. Transportation and warehousing contributed 21,000 positions. Manufacturing chipped in 15,000 jobs. This was broad-based employment strength across multiple sectors. The kind of report that hands the Federal Reserve exactly the cover it needs to maintain current policy settings without facing pressure from doves demanding immediate cuts. They showed their hand. They revealed the playbook. And I'm going to break it down piece by piece. The weapon wasn't deployed Thursday during the forced liquidation. The weapon detonated Friday through a jobs report that rewrote the Fed's entire policy timeline. And the 3-day market closure ensured that no price discovery could occur before participants are forced to react simultaneously Sunday evening. Now, let me show you the bond market reaction that reveals what's really happening beneath the surface. Treasury yields climbed to 4.35% on the 10-year note during Friday's abbreviated session. This wasn't a modest adjustment. This was a decisive departure from the 2-week lows touched earlier in the week when markets briefly entertained softer data, potentially accelerating the Fed's cut timeline. The 10-year yield has climbed 22 basis points over the past month. It sits 33 basis points above its level from 1 year ago. This sustained grind higher reflects the market's grudging acceptance that the Federal Reserve will keep rates unchanged through the remainder of 2026. For silver, which generates no coupon payments and must compete directly with interest-bearing assets, this is a fundamental headwind. But here's what the data reveals that they don't want you to see. Despite the jobs strength, average hourly earnings rose just 0.2% in March versus 0.3% expected. Wage inflation is cooling even as hiring remains robust. This gives the Fed policy flexibility, but it doesn't force tightening. It reinforces higher for longer, not higher and higher. The paper narrative says strong jobs equals no rate cuts equals bearish for silver. The physical reality says persistent inflation plus geopolitical chaos plus structural supply deficit equals massively bullish regardless of short-term rate expectations. This divergence is critical. It tells you Sunday's gap will be driven by paper market panic, not physical market reality. Now let me explain the gap mechanism in detail because understanding this is essential to seeing through what's about to unfold. Silver closed Thursday at $72.99. For 3 full days, no price discovery has occurred. Friday's jobs data arrived. Bond yields surged. The dollar strengthened. Oil remained above $100, and zero adjustment happened in silver pricing. Every piece of information that would normally be absorbed gradually through continuous trading has instead accumulated like water behind a dam. When markets reopen Sunday at 6 p.m. Eastern, that dam breaks. The opening print will reflect every participant's simultaneous reaction to identical facts with no early price action to guide positioning. Gap risk is one of the most underappreciated hazards in commodity trading. If silver opens Sunday at $68, everyone who bought Thursday sits on immediate losses with zero opportunity to have exited at better levels. Stop-loss orders become meaningless because the market skips past them. Liquidity evaporates because everyone is selling and nobody is buying. The magnitude and timing reveal this isn't organic market structure. This is coordinated maximum chaos deployment. Strong jobs data released on Good Friday when markets are closed ensures maximum information asymmetry and maximum volatility when trading resumes. The probability of this timing being coincidental is essentially zero. Now, let me show you what the employment report details reveal about the next 72 hours. The prior month revisions added complexity. January payrolls revised upward by 34,000 jobs to 160,000 total. February revised downward by 41,000 to negative 133,000, largely from healthcare sector strikes. Net effect across 2 months was just 7,000 jobs below previous estimates. This tells you the labor market narrative hasn't fundamentally changed. The March strength isn't an aberration. It's confirmation of persistent resilience that removes Fed urgency for cuts. But it doesn't compel tightening either because wage growth remains contained. In 72 hours of trading from Sunday's open through Tuesday evening, we'll see how markets digest this nuance. Based on current positioning data, I expect initial gap down driven by rate cut disappointment, followed by recovery as traders recognize the Fed isn't tightening either, and physical demand remains unaffected by paper narratives. The data will show the divergence clearly. Paper prices may gap lower. Physical dealer premiums will hold firm or widen. The manipulation creates a buying opportunity for those who understand the game, operates on two different levels simultaneously. Now, let me explain why the jobs report is actually bullish for silver despite what just happened. Strong employment means continued industrial demand. Silver is consumed in electronics, solar panels, medical devices, and defense systems. More economic activity means more silver consumption, not less. The jobs data shows the economy isn't collapsing. Recession fears that would crater industrial metals demand are unfounded. Silver benefits from economic strength through its industrial usage channel even as it faces headwinds from delayed rate cuts through its monetary channel. Strong hiring without proportional wage inflation is the Goldilocks scenario. Growth continues, but doesn't force Fed tightening. This is the best possible environment for assets that straddle industrial and monetary categories. The narrative that strong jobs automatically equals bearish silver ignores half of silver's demand drivers. Every historical principle says silver should benefit from economic resilience paired with persistent inflation. The gap down Sunday violates this fundamental relationship. This violation isn't evidence that silver is broken. It's evidence that paper markets are being manipulated to engineer a shakeout before the next leg higher. Now, let me discuss the rate trap that's being set. The jobs report pushed out rate cut expectations. Markets now price only one cut by year-end, moved from June to September timing. This drove yields higher and strengthened the dollar, but these moves create their own vulnerabilities. Higher yields make American exports less competitive globally. A stronger dollar pressures emerging market debtors who borrowed in dollars. The Fed cannot maintain aggressive tightness without consequences for growth, employment, and financial stability. The very strength engineered through hawkish positioning becomes economically problematic if sustained. This means the higher for longer narrative has limits. They can maintain restrictive policy for specific objectives. They cannot maintain it indefinitely without crashing the economy they're trying to manage. When economic cracks appear, the pivot will be violent. And when that pivot comes, silver explodes higher. The 72-hour window from Sunday's open through Tuesday matters because initial gap reactions typically cannot be sustained beyond short bursts. The economic forces supporting silver, the supply deficit, the industrial demand, the inflation hedge properties reassert themselves quickly once the mechanical gap selling exhausts. Now let me explain what the options market reveals about expectations heading into this gap scenario. Despite Thursday's forced liquidation, options positioning shows traders weren't positioned for strong jobs data. Implied volatility remains elevated, indicating uncertainty about direction. The skew toward puts suggests defensive positioning, but open interest concentrations at higher strike calls remained intact through Thursday's decline. Sophisticated traders maintained bullish exposure despite the sell-off. They're looking through the short-term volatility to the fundamental reality that supply deficits and inflation pressures support higher prices regardless of Fed timing. The smart money in options is using the gap scenario to position for explosive moves. Straddle buying across key strikes indicates expectations for large directional moves from Sunday's open. They recognize the gap mechanics create opportunity for those positioned correctly before the open. This resilience and bullish positioning, despite bearish macro news, frustrates the manipulation objective. They created 3-day information blackout and hawkish jobs data to trigger mass capitulation. But open interest data shows longs holding positions through the uncertainty. The short-term chaos isn't translating to surrender. Now, let me discuss what history says about gap openings after holiday closures. We've seen this pattern before. During the 2020 pandemic, markets closed and reopened with massive gaps that were entirely reversed within days as initial panic gave way to rational analysis. During the 2008 financial crisis, holiday weekend gaps created extreme volatility that smart money exploited. The pattern repeats because the playbook doesn't change. Create maximum information accumulation during market closures. Force simultaneous reaction when trading resumes. Trigger automatic selling from stop losses and margin calls. Accumulate at artificially depressed levels during the chaos. Each cycle follows the same arc. Engineer gap through closure timing. Trigger mechanical selling on reopen. Exhaust forced liquidation. Then lose control as fundamentals reassert and prices recover violently. We're approaching the gap deployment phase now. The Sunday open represents peak chaos capacity. Then physical reality dominates. Now let me explain the psychological warfare component. Releasing strong jobs data on Good Friday when markets are closed serves a propaganda purpose beyond immediate rate cut expectation adjustment. It creates maximum uncertainty. It makes silver holders question their thesis over a long weekend with no ability to act. This psychological damage is intentional. If they can make you panic sell into Sunday's gap down, they win. If they can make you believe the bull case is broken because the Fed won't cut rates in June, maybe you'll exit positions that would have been profitable if held through the volatility. Don't fall for it. The jobs report doesn't change physical market fundamentals. Supply deficits remain. Industrial demand continues. Inflation persists above Fed targets. Geopolitical tensions haven't resolved. The only thing that changed is the timing of rate cuts, which is a secondary factor compared to the structural drivers. A manipulated gap is not a broken market. It's a market with artificial volatility created through closure mechanics and information timing that eventually corrects. Those corrections tend to be violent and sudden when they occur. The psychological operation wants you demoralized before Sunday's open. Stay rational instead. Now let me give you the specific indicators to watch when markets reopen Sunday evening. First, monitor the opening gap size. If silver opens below $70, the manipulation achieved maximum panic. If it opens above $72, the jobs data impact was already priced through Thursday's decline, and further downside is limited. Second, watch first hour volume. High volume acceptance of gap down prices signals genuine distribution and potential for continued weakness. Low volume gap down followed by quick recovery signals forced selling exhaustion and buying opportunity. Volume tells you whether the move has conviction or is mechanical. Third, observe physical dealer premiums Sunday evening and Monday morning. If premiums hold firm or widen while futures gap down, the physical market is rejecting paper price discovery. This divergence signals manipulation approaching its limits. Premium expansion during paper declines is extremely bullish. Fourth, track COMEX delivery notices released Monday. If standing delivery demands increase despite lower prices, it confirms smart money is buying the gap, not selling it. Physical demand holding firm while paper crashes proves the dislocation is temporary and driven by derivatives, not fundamentals. Fifth, monitor the dollar index and 10-year Treasury yield through Sunday evening. If the DXY reverses from Friday's strength or yields pull back from 4.35%, it signals the initial jobs reaction was overdone. These reversals would trigger immediate silver recovery as the bearish catalysts fade. These 5 indicators will tell you within hours of Sunday's open whether the gap represents genuine repricing or temporary manipulation that will be reversed as physical market forces reassert control. Now let me explain the inflation dimension. Most analysis is missing entirely. The jobs report survey period preceded the latest Iran escalation. Employment data captures March conditions before oil spiked above $100. This creates a temporal disconnect between the data the Fed sees and the inflation reality building in energy markets. Oil above $100 is already feeding into gasoline prices. These increases will appear in next week's CPI report. Consensus expecting 0.9% monthly increase, pushing annual inflation to 3.4%. The jobs report shows labor market strength from before the latest inflation impulse hit. The Fed is making policy based on backward-looking data, while forward-looking inflation accelerates. This contradiction resolves over weeks as new data arrives. The initial Sunday gap reaction will focus on jobs, strength, and delayed rate cuts. But as CPI data releases Wednesday showing inflation reaccelerating, the narrative shifts back toward the need for eventual easing despite strong employment. Smart money is positioning for this transition now, while paper prices are suppressed by the gap mechanics and short-term rate expectations. The manipulators are exploiting a temporary window between jobs data and inflation data. That window closes as next week's releases come in hot. Now let me address what Thursday's forced liquidation reveals about Sunday's setup. The April 2nd crash wasn't driven by silver fundamentals. It was mechanical deleveraging across institutional portfolios facing margin calls from equity market declines. Funds sold their most liquid profitable positions to raise cash. Silver became the target because its deep liquid futures markets made it easy to generate immediate funds regardless of underlying conviction. The iShares Silver Trust fell 3.1% Thursday, reflecting mechanical selling pressure, not fundamental reassessment. This was automated stop-loss cascades, not human discretion. The essential insight is Thursday's selling was forced, not voluntary. Traders didn't choose to sell because their silver thesis changed. They were compelled to sell to meet margin requirements. That forced selling exhausted into Thursday's close at $72.99. Now we face a 3-day gap with entirely different catalyst. Sunday's gap will show whether new sellers emerge based on jobs data, or whether Thursday's liquidation already cleared weak hands and current levels attract buyers. The combination of forced selling, Thursday plus gap mechanics, Sunday creates dual opportunity for engineered downside that won't reflect actual physical market conditions. Now let me explain what happens when gap manipulation exhausts. Every gap-driven shakeout has capacity limits. Opening volatility requires panicked sellers willing to hit bids blindly. Sustained downside requires continued selling after the initial gap. If sellers exhaust in the first hour, the gap gets filled and prices recover. When manipulation through gap mechanics fails against a backdrop of genuine physical tightness, the reversal is violent. The Sunday gap may create an artificial low that becomes the launch point for the next major leg higher as bargain hunters recognize the disconnect between paper panic and physical reality. We saw this in 2020 when paper crashed while physical premiums exploded. We saw this in 2011 when emergency interventions created gaps that were followed by parabolic advances to $50. The current setup has more fundamental support than previous cycles. Industrial demand higher, supply deficits larger, inflation more persistent. When this gap manipulation fails, and it will fail, the recovery won't be gradual. It will be a violent gap fill followed by continuation higher as the structural bull case reasserts. Positioned for that reversal, not for the temporary Sunday chaos. Now let me give you the actionable framework for Sunday evening. If you hold physical silver, hold it. The gap is paper market mechanics, not physical market fundamentals. Your metal is still your metal. No counterparty risk, no margin calls, no forced liquidation. The paper price disconnecting from physical value creates opportunity, not crisis. If you hold paper positions with adequate margin, maintain them if you have buffer for gap volatility. The manipulation will exhaust. Recovery will come. But if your margin tight, the gap could trigger automatic liquidation before the reversal. Know your risk limits before Sunday's open. If you have dry powder, the gap down scenario creates one of the best buying opportunities in months. Strong jobs data doesn't change supply deficits or inflation. Prices gapping lower on rate cut timing while fundamentals remain intact is a gift. Deploy capital into weakness if the gap proves severe. If you were considering selling, understand you're doing exactly what gap manipulation is designed to achieve. Selling into Sunday's chaos is capitulating at precisely the wrong moment. Hold through the volatility. The data coming next week will shift narratives back toward inflation concerns and silver recovery. If you're new to silver, study this gap scenario carefully. This is how they engineer maximum pain through market closure timing and information control. Understanding these mechanics prepares you for future cycles and prevents panic decisions. The next 72 hours will reveal whether gap manipulation exhausts quickly or has sustained selling pressure behind it. Either way, the longer-term trajectory remains up because the jobs report doesn't change the fundamental reality that there isn't enough physical silver to meet demand. Let me close with what the manipulators don't want you to understand. Markets closed Thursday at $72.99. Friday delivered strong jobs data that removed near-term rate cut expectations. 3 days of information blackout prevented gradual price discovery. Sunday's 6 p.m. Eastern Open will force simultaneous reaction from all participants. This gap scenario should be impossible under normal market structure. The fact that it's happening proves the system is designed for maximum chaos deployment, not efficient price discovery. The jobs report was the excuse. The 3-day closure was the weapon. The gap mechanics will attempt to trigger mass liquidation, but physical demand remains unaffected by paper gaps. COMEX inventories continue at structural lows. Industrial consumption doesn't stop because the Fed delayed rate cuts. The divergence between paper chaos and physical reality grows wider with each manipulation event. Within 72 hours, we'll have CPI data Wednesday showing whether inflation is reaccelerating despite strong jobs. History suggests it will. History suggests the Sunday gap will be reversed as inflation data forces narrative shift back toward eventual easing necessity. The job strength is actually bullish for silver's industrial demand. The inflation persistence is bullish for silver's monetary properties. The gap manipulation can delay the bull case. It cannot prevent it. The cipher is clear. The jobs report removed cut timing. The market closure created the gap weapon. Sunday's open deploys maximum volatility. Watch the indicators I described. Monitor the gap size, the volume, the premiums, the delivery data, the dollar and yield reversals. Position for the recovery. Don't let them shake your conviction through gap mechanics. They engineered a 3-day information blackout into a jobs report that removed rate cut urgency. Think about how desperate that timing is. Think about what happens when CPI prints Hot Wednesday and the narrative reverses. Think about what happens when the gap fills and physical reality reasserts. This is the market cipher. Markets reopen Sunday 6 p.m. Eastern. The gap between 72.99 and the opening print will tell the first part of the story. The reversal over the following 72 hours will tell the rest. Like and subscribe if you want. The post-gap analysis, Monday breaking down, whether manipulation exhausted or has remaining capacity. Share this video with anyone confused about how holiday closures create weaponized gap scenarios. The jobs, data dropped, the market's closed, the gap is loaded, and none of it changes the fundamental reality. Supply deficits persist. Inflation continues. Industrial demand grows. That reality will assert itself. Position accordingly before it does.